we talk around the aspect of presumptive tax, there are various areas you can look at it. It goes even beyond just the informal sector. It goes into a lot of things about having your own intelligence gathering. But don't let me take the position of the paper presenter. Let's try to, take opportunity to really soak ourselves into as much as we can. You don't know when this is going to be very useful for you.
I will start by saying, why do tax or revenue authorities use presumptive taxation? Why do they use it? The main reason for using presumptive taxation is because they want to improve revenue generation. And compliance is very low. And when compliance is very low, the next thing to do is to look out for alternative means to get non-compliance taxpayers to see how they can make them comply. So presumptive tax is a tool to check tax avoidance, to check tax evasions. So it's a tool deployed by the Revenue Authority. And in doing that, they employ different types of approaches to do this. And we'll be looking at some of those methods that have been adopted in doing that. And maybe before I go straight to the paper, I will first like to deliver the goodwill message of the paper presenter, Mr. Bafolonsho. He sent his greeting, but is unavoidably absent to be able to take this paper. And presumptive tax, like I mentioned, is coming up with alternative approach to tax payer. It's an alternative approach. So presumptive tax basically is use of perceived income to ascertain the tax payable by unwilling taxpayers, or taxpayers that are not fully compliant, because it's not enough to say that, oh, I have filed my tax returns and that has become final. Tax authority can still look at it and say, no, we don't agree with what you have filed, and because of that, we want to use alternative approach to say this is what you should pay. So it's use of perceived income in ascertaining the tax payable by a taxpayer. Currently in Nigeria, we use the self-assessment tax system, whereby taxpayers are expected to compute their tax on their own after they have declared their income. They are expected to determine what is their tax liability. They compute and they make payments of the tax they are supposed to pay. So the system actually passes that burden of compliance to the taxpayers. Okay, that's the current system we have. But why has this system not, or why has tax authority decided to then look at other means of taxing taxpayers or reviewing this self-assessment method or system we have? It's because compliance is very low, and there are some unwilling taxpayers or some taxpayers that are willing or using for means to evade tax. So that's the reason for bringing presumptive tax. The word presumptive tax on its own, we may not see it in the tax law anywhere where it is written as presumptive tax. But we are all familiar here with first of judgments that the tax authority employ most times. And most times they do this when they look at taxpayers' return to say that, no, we don't agree with what you have filed. But before we go into the details of all that, like I said, the reason for employing this tool in the first place is because of low compliance of taxpayers. And looking at Nigeria, we have the least tax to GDP ratio in Africa as a whole. The least. Currently, based on the 2019 data available, Nigeria will have about 6% tax to GDP rate. Compared to a country like Tunisia, which as of 2019, they have 34.3%. So we have the least in Africa. If you look at other jurisdictions or even other countries in Africa and look at their compliance rate, you see that our compliance rate in Nigeria is far, and very low. The few people in the tax net, do they all comply or do what they're supposed to do in line with the existing laws? And one of the earlier speakers mentioned the fact that even in the formal sector, people in employment, which are the major people, for instance, when you look at personal income tax, like the tax net, we still have about shortfall of about 30 to 40% of that people in that category that are not even in the tax net at all. Before you talk about company, which means that a lot of people, especially the informal sector, they are not in the tax net at all. Now when you go to Europe, you look at Europe, you see that the tax to GDP rate in Europe as of 2020 is about 22 to about 46%, compared to Nigeria, 6%. Now, if you move further to look at the OECD nations, you see that the minimum you have among the OECD nations is about 16.5%, and we have as high as 46.3%, which is for Denmark. So by the time you compare all these indices, you see that the compliance rate in Nigeria is far below expectation. And according to IMF research, you cannot separate economic growth from taxation. Both of them are together. And looking at these OECD countries, there is a research result that showed that at least about 12% of the tax to GDP is being accounted for by economic growth. If you then bring that to Nigeria, again, you see that why are we really not having that growth as expected? So it's expected that if the economy is growing, the tax performance should also improve in that order. So that's just like a background to say that deployment of the presumptive tax approach is as a result of low compliance with the current tax legislations we have in Nigeria. And now, when we talk about presumptive tax, like I've mentioned, it's use of passive income to determine what the tax liability of the taxpayer would be. And of course, there is no mention of that presumptive tax, like I mentioned, but we are familiar with best of judgment. So tax authority has been empowered by the existing legislations to deploy any of those methods in determining what the tax should be where they feel is not adequate. In our existing legislation, that we know that all the laws currently that are being deployed in the country for taxation of both individuals and the companies. In the Companies Income Tax Act, Section 30 and Section 65 specifically talk about giving the tax authorities the power to use their discretion to determine what profit of a company should be or what the tax should be. And if you also take it down to Personal Income Tax Act, you see that in Section 54, there is the section of provisions that talk about best of judgment, which means when the tax authority look at your tax returns, they can say, no, we don't agree with what you have. And they may decide to look for alternative means to say, this is what we want to do. If you also go further to the Petroleum Profit Tax Act and the Petroleum Industry Act, which was passed last year, you see that in Section 35 for the Petroleum Profit Tax Act, they also talk about use of best of judgment. And if you go to Section 283 of the Petroleum Industry Act, you will also see that same provision there, which means it's not new. It's something that has always been there, and it's something that is supported by the relevant provisions of the Tax Act. Why exactly do we use, or the tax authorities use, presumptive tax? One is that because of taxpayers' failure to file their tax returns, where as a taxpayer or as a taxpayer, whether individual or company, you have failed to file your tax returns, that alone will be the reason why tax authority, once you are in the tax debt or they know you, they can say that, oh, you are expected to file your returns, to declare your returns, declare your tax, but you have failed to fulfill this obligation. And for that, they have liberty to apply presumptive tax. The other reason is because of unreliable tax returns and financial statements. I know we are all familiar with creative accounting, where people sit down, even before they file the tax return, they can determine from the beginning and say, this is how much tax I want to pay, and then work from that tax they want to pay back to what their revenue should be. And by the time you then do that, it pays and you use it to file your tax returns. If tax authority can unravel that to say that what you have done is not the right thing, then they can also apply presumptive tax in that case. Again, it's because of people that want to evade tax. You see a lot of businesses, running businesses of billions and all that, but they still don't want to pay tax. But one way or the other, the tax authorities are going to know that, oh, this person is actually making revenue, and they can apply presumptive tax in that case. Another is where at times it's very, very hard to be able to say this is the profit that is coming from this particular business they have done in Nigeria. And when it's very difficult to ascertain what that profit should be, then the tax authority will be at liberty to apply presumptive tax on such a company. So, going into the company's income tax act that I've mentioned, we give the tax authority the power to apply presumptive tax. If you look at section 30 specifically in the Company's Income Tax Act, it talks about deemed income, deemed profit. And that will apply where the tax authority have look at your tax returns for any year of assessment as a company, and for state internal revenue, they also look at your tax returns as an individual and say that in their opinion what you have filed or what you have declared is not adequate. Then they are liberty relying on those provisions of the Act to determine what your profit should be. They can say this is what a comparable, just like individuals. When you look at individuals, most times state internal revenue service will always say that as an expatriate, this is the minimum amount of revenue or income that an expatriate must declare. That could be the basis to say that, okay, if company A, they have filed returns on their expatriate, and one is declaring an income of 10 million minimum for all the expatriates, and another one is coming to say, no, my expatriates, I pay them 3 million, 4 million per annum. Tax authority can on that basis to say, no, what you have filed is inadequate and we are not going to accept that. So the tax law actually gave that room to say that in the event that the tax returns that taxpayer has submitted are unreliable, then the tax authority can determine what is the reasonable income that such a taxpayer should pay. And the word, the Act itself used the word to say that the tax authority can assess or charge that company or individual, as the case may be for that year of assessment, on such fair and reasonable percentage of its turnover of the trade or business as the board may determine. So the next question will be, what is fair and reasonable? Because most times you see taxpayers and tax authorities having this issue of, no, you have assessed me based on best of judgment. If you look at FRS, for instance, the approach would be that FRS will say that the minimum profit for a company should be, when they are using deemed income, should be 20% of their revenue as profit, and then apply 30% on that profit, which leaves you with a minimum tax rate of 6% of your entire gross income. The question now is that 20% that is deemed as profit, is it fair and reasonable? So what is fair and reasonable is actually a big issue. Now, at what point can the tax authority use this, looking at the wordings of that section 30 of the Companies Income Tax Act? One is that when the trade or business produces no accessible profit. You can have two businesses running in the same industry. One has filed tax returns, they have declared profit of say 50 million. Another is filing, but they are declaring loss. So tax authority can in that case say that no, what you have declared as profit is not reasonable. And then another is where, in the opinion of the tax authority, the accessible profit of that company or the income is less than what is expected to be. Just like I mentioned earlier, in the case of expatriate, where you have a company filing tax return for an expatriate to say that this expatriate is earning 4 million, 5 million per annum. Whereas some other companies are filing for their own expatriate, we know that the level of expertise they experience may make the salary to differ. But the question will be that how will somebody come all the way from Europe to Nigeria to earn 4 million naira?
Of course, it's impossible.
Sorry?
It is impossible.
It's possible?
It is impossible.
Thank you so much for listening.
That is why it is really the theme for this conference. We are talking about presumptive taxation and ICT in revenue generation. Pedabo has tried giving us, some ideas around what is presumptive tax, what are some of the sections of the Nigerian laws that support the process of presumptive taxation, both from the company's income tax, from personal income tax, from petroleum profit and whatever. But I'm going to be asking our discussant, particularly my sister, Dr. Koka. I want us to be a bit more focused on diving into some areas. At the risk of not repeating what Pedabo has said, I would like you to kind of throw a bit more light really into what is presumed income. Okay? And when we talk around aspect of presumed income, that brings about the taxation of that income. What are the merits and demerits of that presumptive taxation? Okay? And in talking about that merits and demerits, mentioning that it is presumed income, there's a simplifying understanding that you have used some methods in getting that information that is giving you that income. How do you bring ICT into really getting that process of that presumed income that you want to tax?